This is Nightly Business Report with Sue Herrera and Bill Griffin.
Bruised Apple. The company reports its first holiday quarter profit and revenue decline in a decade, putting its flagship iPhone in focus.
Chapter 11, PG&E officially files for bankruptcy, triggering one of the largest, if somewhat unusual, corporate reorganizations in years.
Phone scams, how robocallers tried to cash in when the government was partially shut down, and why it may continue. Those stories and much more tonight on Nightly Business Report for Tuesday, January 29th.
Good evening, everyone, and welcome. It's the quarter that Apple warned about. The company reported its first holiday quarter drop in earnings and revenue in more than a decade. Weak iPhone sales and slowing demand in China reduced revenue. And its outlook isn't great either. Apple says its revenue for the current quarter will fall short of Wall Street expectations. Here are the numbers. Apple earned $4.18 a share, 1 cent better than estimates. Revenue fell from a year ago to $84 billion. But investors are taking the results in stride, sending the stock initially higher in after-hours trading. Josh Lipton has more on Apple's quarter.
$10.9 billion. That was one big number in Apple's latest earnings report. It refers to the revenue that Apple generated from its services division. So that's the App Store, Apple Music, Apple Pay. It was up 19%. Apple indicated it would be in that range when the company pre-announced Q1 results earlier this month. But here was a new metric that Apple gave too. Now they're giving us services gross margins. This is a new performance metric they're offering investors. They say that came in at 62.8%, so much higher than the overall company. Investors focus very hard on that services division because it is faster growing, and now they have greater insight into how profitable it is as well. For Nightly Business Report, I'm Josh Lipton, Cupertino, California.
Let's turn now to Angelo Zeno. He's get more on Apple's earnings and what he sees ahead. He's senior tech analyst at CFRA Research. Good to see you. Thanks for joining us tonight.
Thanks for having me.
Tim Cook wants everybody to believe that services can make up for a shortfall in the hardware division. Are you convinced that that's the case?
Well, I think it's actually going to be collectively from services and non-iPhone businesses. When you actually look at the power of the non-iPhone business here this quarter, it grew about 19%. And we see that as an enormous positive. You look at, let's say, iPad revenue. This is the highest number we've seen in 3 years. So yes, we think the growth story here for Apple will continue to be services, and we do buy into that thesis. But at the end of the day, we think it's a lot more than just services. It's wearables as well as other non-iPhone type revenue.
Are Wall Street's expectations still too high for Apple at this point? I mean, Tim Cook has been very upfront about the situation between the U.S. and China and how it has affected his business. That has not yet been resolved. So what are the street's expectations in your view, and are they realistic?
Well, it's interesting because looking at the results here, it does look like the poor results were really contained in China. China looks like it dropped about 27% on a year-over-year basis. But the positive is we actually saw growth in areas like the Americas, and that kind of tells you that consumers are actually willing to pay for these higher priced devices outside of China, and we think that's a very positive thing. When we look at the actual guidance that was given here for the March quarter, we do think the numbers probably have to come down slightly, but that being said, we think it definitely alleviates a worst case type of scenario.
Before you go, the stock is down sharply since last summer on these lowered expectations. For the long-term investor, do you like Apple?
We continue to recommend the stock. We do have a buy recommendation, and our 12-month target price is $195.
Very good. Angelo Zeno with CFRA Research. Thanks again for joining us tonight.
All right, thanks for having me.
On Wall Street, stocks struggled to find direction, even with the release of a number of big earnings reports and ahead of U.S.-China trade talks and a Fed decision. So there's a lot in the mix. The Dow Jones Industrial Average added 51 points to 24,579. The Nasdaq fell 57, and the S&P 500 was down 3.
Pfizer was the best performing Dow component today after the company reported better than expected earnings and cited strength in several high-profile medicines. Pfizer's forecast was pretty much in line with expectations as well, and that stock rose more than 3% in trade today. But fellow Dow components 3M and Verizon gave downbeat forecasts. 3M pointed to weaker demand in China, and Verizon said it sees no increase in its profits in 2019. Shares of 3M were higher today, but Verizon fell. And now that we're about a quarter of the way through earnings season, believe it or not, some new trends are starting to take shape. Bob Pisani has details for us.
Let's be honest. The earnings guidance has been lousy in the last 24 hours, yet the stock market appears to be taking it all in stride. So what's going on? We had Pfizer, we had 3M, Lockheed Martin, Harley-Davidson. They all cut their profit forecast for 2019. Some cited tariffs, some cited rising raw material costs, some cited slower global growth. Well, it wasn't all bad. A number of companies, Verizon and Rockwell Automation, Dover and Xerox, they provided 2019 guidance that was in line or a little bit better. So not all bad. But it looks like the market sniffed out these lower estimates when we had all that market turmoil back in December, meaning a lot of this has been priced in already. All right, that's a little bit of good news. We've got 130 companies reporting so far. That's a quarter of the way through earnings season. Here's the major trends so far. First, fewer companies are posting earnings and revenues beats than usual for the fourth quarter. That's not good. Guidance is trending lower for the full year, 2019. So full year growth estimates for the S&P 500 have come down since early October and are now in the low single digits. So down to about 5% from about 10% growth at the start of October. This is for 2019. But there's a debate over just how much earnings growth will slow down. Some believe that we'll be entering an earnings recession this year. That would be 2 straight quarters of negative earnings growth. And others say earnings will help and hold up in the low single digits. The one thing the market can't wish away is a slowing global economy. A number of firms have alluded to this, and other big names, including Whirlpool and AK Steel and 3M, they've also referenced higher costs eating into margins. Now, you want to really change the market sentiment? What we need now is a pickup in global activity. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And now to the Federal Reserve, which, as we mentioned, started its 2-day policy meeting. And that makes it a good time to survey economists, money managers, and strategists about the economy and the market. Steve Leisman rounds up the results.
The chance of recession in the next 12 months, forecast by respondents to the CNBC Fed survey, spiked to its highest level in 3 years amid growing worries about global economic weakness, Fed rate hikes, the market sell-off, trade tensions, and the government shutdown effects. The recession probability rose to 26%, the third straight increase. It's above the 22% average for the past 8 years, and it was last this high in January 2016. That followed another bout of market volatility. The uncertainty then prompted the Fed to hold off on rate hikes, and that's the expectation now. The 46 respondents to the January survey believe the Fed will now hike just once in 2019, down from a forecast of 2 in the December survey. And just 48% of respondents believe the Fed will hike in 2020. 37% believe the Fed will actually cut rates. 100% actually expect no rate hike from the January meeting. Respondents forecast modest stock gains of just 4% in each of the next 2 years. That would bring the S&P 500 up to 2846 by 2020. The survey showed 2 schools of thought on the outlook. One sees a weaker U.S. economy as unavoidable, in part due to global economic weakness and waning government stimulus. The other believes Washington has caused many of the problems, and with trade and immigration deals and a bit of stability, could clear the way for stronger economic growth and healthy market gains. For Nightly Business Report, I'm Steve Leisman.
Time to take a look at some of today's upgrades and downgrades. We begin with another Dow component. American Express was upgraded to overweight from neutral at Atlantic Equities. The analyst cited the stock's 9% dividend yield and its valuations. The stock price is now $128, and that stock rose a fraction today to 196 cents. BlackRock was upgraded to buy from hold at Jefferies. The analyst cited BlackRock's industry-leading organic growth. Price target $468, and shares rose slightly to $407.62.
Nvidia was downgraded to underperform from buy at Needham. The analyst cites the potential for a further decline in demand in some of Nvidia's key businesses like gaming and data centers. We told you about the revenue warning the company issued yesterday. The price target of $225 was removed with no new price target added. The stock fell about 4.5% to $131.60. Square was downgraded to underperform from market perform at Raymond James. The analyst cites a lack of growth opportunities as well as Square's move into banking. The price target is $56. The stock dropped 10% to $68.56.
As expected, PG&E has filed for bankruptcy. California's largest utility is seeking Chapter 11 protection as liabilities continue to mount from the state's most recent deadly wildfires. Now, when a company files for bankruptcy, its shares usually lose all value and the stock price falls to near zero. But as you can see, that's not what happened today. In fact, PG&E shares rose by 16%. And as Aditi Roy reports, that in part is why this corporate reorganization is not typical.
PG&E's bankruptcy filing comes as the utility faces tens of billions of dollars in potential liabilities for Northern California wildfires in 2017 and 2018. Reaction to the filing was swift. California Assemblyman Chris Holden, who chairs the Utilities and Energy Committee, said it was always my hope to see PG&E not find itself in a position where they would file for bankruptcy. Experts say PG&E will likely have 120 days to come up with a reorganization plan. Creditors are expected to identify themselves. Other stakeholders include regulators, wildfire victims, and ratepayers. All of these groups will likely contest the utility's plan, and the whole process could take months, if not years. While PG&E filed for bankruptcy in 2001, analysts say this filing is different because of the uncertainty of the wildfire liabilities.
Here, I think what makes this situation radically different in my mind is that the company will likely have to raise prices in order to recover damages, primarily legal damages, arising out of wildfire claims.
And that has already led to outrage. Dozens of activists spoke out about PG&E at a regulatory meeting leading up to the bankruptcy filing.
They've already been through this before, and they just reorganize, come out, and continue to inflict pain, misery, and death on the people of California.
PG&E has put profits over safety over and over again with no consequences.
As all the parties, which include major institutional shareholders like BlackRock, Vanguard, and T. Rowe Price, maul their claims, some analysts say it's too early to tell how they'll make out.
I think right now I have more questions than answers. I think it's just way too early to try and make a guess as to what the equity value that's going to be left over in the bankruptcy.
After the last PG&E bankruptcy, most parties were made whole and the stock price went up. While analysts say those factors could have contributed to the stock price going up today, it's unclear how shareholders will make out this time around. Experts say it all depends on the appetite of lawmakers to get involved, and so far state officials are staying tight-lipped. For Nightly Business Report, I'm Aditi Roy, San Francisco.
Still ahead, mortgage market overhaul. Are changes in store for Fannie Mae and Freddie Mac? They've turned into cash cows for the government. Apple has disabled a group chat FaceTime function that users said allowed eavesdropping. Users calling another iPhone, iPad, or Mac computer could hear audio even if the receiver did not accept the call. In a statement today, Apple says it is aware of the issue and has identified a fix that will be released later this week.
High-level trade talks between the U.S. and China are set to resume tomorrow. The hope is that the two countries can defuse the escalating trade war. But the meetings begin just days after the Justice Department filed those charges against Chinese telecom company Huawei, a development we told you about yesterday. The U.S. alleges that Huawei stole confidential information and violated U.S. sanctions that prohibited sales to Iran. And as Eunice Yoon reports, Beijing is not happy.
Chinese officials are slamming the U.S. indictments, with the IT ministry calling the move unfair and immoral, and the foreign ministry accusing the U.S. of, quote, unreasonable suppression of Chinese companies. The ministry also urged the U.S. to drop the arrest warrant for Huawei CFO Meng Wanzhou. The U.S. Justice Department unveiled 2 indictments. The first, a 13-count indictment filed in New York, alleging that Huawei misled bankers and U.S. authorities to continue to do business in Iran despite U.S. sanctions. The U.S. believes the CFO orchestrated the scheme. The second 10-count indictment charges 2 Huawei affiliates with attempting to steal robotics technology from U.S. carrier T-Mobile and says Huawei offered bonuses to employees who obtained confidential information from rival companies. Huawei issued a statement saying it's disappointed to learn of the charges. It denies that it or its subsidiary or affiliate have committed any of the asserted violations of U.S. law and is not aware of any wrongdoing of Ms. Meng. Meng's lawyer says that the CFO shouldn't be held hostage to U.S.-China relations. And as it turns out, the indictments came the same day that Vice Premier Liu He arrived in Washington for trade talks. U.S. Commerce Secretary Wilbur Ross says that the 2 events are unrelated, but the Chinese have been viewing the targeting of Huawei as political. So many people here believe that this should cast a shadow over the negotiations. For Nightly Business Report, I'm Eunice Yoon in Beijing.
GameStop isn't playing games. That's where we begin tonight's market focus. The retailer says it is no longer looking to sell the company. The board determined that there's not enough available financing on terms that a buyer would want. So the company is struggling to sell physical games to customers who can now purchase those and download them at home. The stock dropped 27% to $11.28. Pulte Group reported its worst quarterly fall in orders since 2013. The home builder said the outlook for the spring selling season is so uncertain that the company is forced to spend heavily on buyer incentives. Despite the weaker forecast, Pulte reported better than expected earnings and revenue in the most recent quarter. The stock climbed gradually throughout the day, closing up a fraction to $27.25. Brinker International, which owns casual dining chains Chili's and Maggiano's, reported a rise in profit on an increase in sales. But the company says margins are coming under pressure because of higher wages, rent, and maintenance expenses. Shares of Brinker fell more than 10% to $42.36.
Xerox reported better than expected earnings, but revenue did come in a little short. The office technology provider said its strategic initiatives will help boost earnings above expectations this year. The company's been simplifying and streamlining its business in a move to try and improve returns. The stock rose 11% today to $27.07. eBay reported better than expected earnings and revenue, with the company issuing its first ever dividend. It also increased its share buyback program. And the CEO said he is confident in the company's future growth prospects. All of that sent the stock higher, then lower in the after-hours trading. Shares fell in the regular session to $33.69.
Mortgage giants Fannie Mae and Freddie Mac could be getting an overhaul. The Trump administration could announce plans as early as next month to end government control of the 2 companies, but says that it will work with Congress on developing a policy for housing finance reform. Mark Zandi joins us now to discuss what that could all mean for the market and the housing market in particular. He's the chief economist with Moody's Analytics. Always good to have you here, Mark. Welcome back.
Thanks, Sue.
What do you anticipate the administration's plan will look like? And what are Fannie and Freddie going to look like at the end of this?
Well, I think they're going to work with Congress. Congress, as you know, has been trying to solve this problem since the financial crisis over 10 years ago. It's the last major problem since the crisis that has not been resolved. So it's a very thorny, particularly difficult issue. Congress needs to be involved, and I think the administration at the end of the day will get them involved and try to figure out how to privatize Fannie and Freddie in a way that preserves all the good things that Fannie and Freddie does to the mortgage and housing markets, provide mortgage credit to all of us at low interest rates and to underserved communities, but also do it in a way that gets taxpayers out of shouldering the risks involved in doing that.
Okay, that's what I'm curious about. I mean, they've been in conservatorship for a decade now. And everybody's trying to come up with a solution. Even you and a few other economists a few years ago came up with a solution that would combine Fannie and Freddie into a single entity. But I've never understood what the hesitation is to get this thing off the ground. Is it simply the worry of how much the government and taxpayers will be on the hook should they need to be bailed out again if there's another financial crisis?
Yeah, great question. Well, here's the thing, Bill. There's a lot of stakeholders involved here, right? I mean, these are among the largest financial institutions on the planet. They're key to the housing market and therefore, by extension, to the U.S. economy and the global economy. So we have to get this right. You can't screw it up. And you got the mortgage industry, you've got the housing industry, you've got progressive groups that are rightfully worried about mortgage credit to underserved groups, low, middle-income households. You have conservative groups who are very concerned about the government's backstop here. I mean, should taxpayers really be taking the risk here? So there's a lot of people involved, a lot of moving parts, and if you mess this up, you mess up the U.S. economy, the global economy, so you have to get it right.
Well, I was going to ask you about that, specifically the housing economy. As we start to see these plans unveiled and debated, could it have a chilling effect on the housing market?
Well, I mean, we have to be careful. I don't think the administration or Congress would go down a path that would be disruptive to the mortgage market. That's why it's taking so long. But it is important. So nearly half of all single-family residential mortgages made today are made by Fannie Mae and Freddie Mac. So, it's a big deal. But I'm confident that the administration and Congress will work together and make sure that they get this right, because if they don't, it would be a big problem.
Mark Zandi, as always, thank you. Mark's with Moody's Analytics.
Thank you.
And coming up, the new scheme used by robocallers during the shutdown and maybe even beyond. As you are no doubt well aware by now, former Starbucks CEO Howard Schultz is seriously thinking about mounting an independent bid for the presidency. Since his announcement, though, the other night, some groups have already threatened to boycott the coffee chain. And our Andrew Ross Sorkin asked Mr. Schultz if he is concerned about the impact his candidacy would have on the Starbucks brand.
Are you worried, by the way, about potential boycotts for Starbucks?
No. I mean, I think Starbucks is serving about 100 million people a week around the world, about 70 million in the U.S. I've got great faith in the American people. I don't think they're going to boycott Starbucks.
So far, investors don't seem concerned either. The stock has been relatively flat over the past two trading sessions.
Consumer confidence falls to an 18-month low. According to the Conference Board, Americans are less optimistic about their future, in part because of the partial government shutdown and the volatile financial markets. However, overall reading is still historically high, indicating consumers think the economy is doing fine.
There is evidence now that robocallers tried to capitalize on the recent government shutdown. Approximately 5 billion robocalls are made every month, and while that number has been consistent, the context is changing. Our Andrea Day takes a look now at these highly trained scammers who can adjust their schemes on a dime.
Just days into the shutdown and calls were already rolling in, according to Alex Quilici, CEO of the robocall stopping app Umail. The scammers looking to cash in on consumer fears. The most used call, a warning about IRS debt.
Hello, I have an important update regarding your IRS tax debt. The recent government shutdown is affecting your standing with the IRS, and although some IRS operations are down, billing and collections remain active. So give me a call back at this number.
It's already scary the IRS is calling you. It's even more scary when the government shutdown is saying, hey, maybe your payment didn't get through to the IRS.
And he says it worked. Umail estimates 1 million plus got that call, and between 3 to 5% actually called the number back.
So some fraction of those people are going to get scammed, and it's going to be for real money.
Here's another call used during the shutdown.
I was actually calling because in lieu of the government shutdown, back federal taxes are now being dismissed at just an unstoppable rate. We can take advantage of this situation and help you clear out not just your federal back taxes, but also some state tax issues you might be facing. When you get this message, please give me a call back.
And if consumers turn to the government websites to file a complaint or join the Do Not Call registry, here's what they got. The agencies who oversee the issue, the FCC and the FTC, both unavailable.
The real impact for all this is the long-term enforcement. So had the government shutdown stayed shut down for a long time, the FCC isn't chasing the bad guys.
The FCC directed us to its now functioning website, which says the agency is working to stop illegal robocalls and has launched several initiatives. The FTC tells us because of the government shutdown, the FTC was not funded and could not receive complaints from consumers. But we are open and very much want people to report such calls to the FTC at donotcall.gov. But it's not just the shutdown. Quilici says robocallers are standing by, ready to jump.
These guys are really responding to current events where they can.
So what's next, assuming the government stays open?
I fully expect to start seeing, hey, the government is back open, we can reduce your tax debt, as a scam.
For Nightly Business Report, I'm Andrea Day.
And in fact, Quilici predicts that we will probably see even more robocalls now that the government has opened, simply because it has worked before. By the way, he says most calls come from India, but in order to sound more convincing or professional, the scammers book voiceover talent online from the United States.
And before we go, let's take a final look at the day on Wall Street. The Dow added 51 points, the Nasdaq fell 57, and the S&P 500 was down 3. And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.